Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. On today's episode, deal makers enter a wartime environment. We're going to cover how the war in Iran changes the calculus for global deals. We'll get perspective on that in an exclusive interview with PJT Partners founder, chairman, and CEO Paul Taubman. He's also going to share what kinds of deals he sees in the pipeline. And as you see there, we'll also be talking about activism, an exclusive interview with the Starboard CEO, Jeff Smith. News breaking overnight that his firm has amassed a roughly $350 million stake in Carmax. But first, let's bring in the reporters behind today's big deals. First up, as geopolitical volatility slows down deal making, one sector is still getting attention, and that's defense companies. Bloomberg Deals executive editor Aaron Kirchfield joins us for more on this. And Aaron, you and the team have been reporting on this. Deals slowing down, but then you get the likes of Advent selling a UK maritime company. Is this just the only sector that's alive and well at the moment?
Yeah, I think you're absolutely right that when generally, obviously, a lot of deals are on pause because of the situation in Iran, there's one big exception, as you say, and that's defense. For obvious reasons, you know, with conflicts going on from Ukraine to Iran and beyond, we're just seeing a huge surge in demand for these defense and defense tech companies. So owners, whether it's private equity firms like Advent or big primes like Rheinmetall, are out there aggressively selling defense assets or buying to build their war chest, literally and figuratively, for future demand.
Then I guess what happens, Aaron, from here on out? I mean, I don't want to be crass, but it's kind of like, you know, Seahawks win the Super Bowl and they look to sell themselves. As this war drags on, what does the pipeline look like? Does it continue to boom for defense companies?
Yeah, I think that was the really big question is, are we going to see just a bubble or a permanent trend? And talking to M&A advisors in this space, they're saying they're busier than they have been in the last quarter century. And we know that the pipeline is full. Look at some of the big IPOs coming up. We had one of the biggest defense IPOs of all time, CSG, an ammo company, launch earlier this year. And KNDS, the maker of the Leopard tank, which is used actively in Ukraine, is also planning an IPO before summer. So I think we're going to see some mega transactions because investors, even those that, you know, previously hesitated to invest in defense, are clamoring for exposure to the sector. As you say, everyone is, you know, not celebrating the tragedies we're seeing in Iran, but they realize there is a real demand for the equipment, for the technology.
Hey, Aaron, thank you so much for this and all of your reporting. Bloomberg Deals executive editor and defense reporter Aaron Kirchfield. Now let's check on one of the backbones of the deal-making universe, and that is private credit. We learned overnight that JPMorgan is restricting some lending to private credit funds, and Bloomberg's Lucia Giftopoulou joins us now on this. And so, Lucia, it's basically the money that they're lending to private credit firms. They're saying your collateral that you have, we're not valuing it as much. Why are they making this decision, and what's the impact of it?
I think the restrictions are basically made on loans for software companies, where risk of AI has kind of made people very wary and has caused, you know, some of the funds to write down their assets. And I think in the wider context of what's happening, that doesn't really look great for private credit because it's facing a lot of stress right now, left, right, and center. And having JPMorgan say, hey, guys, you know, we're going to hold off a bit on how much money we're giving you, even if it's just one bank, I think the optics of it are not great.
Well, where there's volatility, there's also opportunity. And you've been reporting on what Boaz Weinstein has been doing. Where is he picking up some of the fallen off pieces in the private credit world?
So what he thinks is that there's going to be a lot of requests for indemptions, and there's a lot of pockets of opportunity for him. As he told us, he plans to buy pessimism and sell optimism at full price. So he's basically giving discounted offers to get investors out of the funds where the managers cannot honor their redemption requests.
All right, Lucia, thank you very much. Excellent reporting. That is Lucia Giftopoulou. One deal that we are monitoring today, Bill Ackman is looking to raise up to $10 billion in an IPO at the New York Stock Exchange. It's the billionaire's latest attempt to bring his long-term investment strategy to a broader base of investors. Let's go to Scarlett Fu for more on the context. Scarlett.
That's right. This is not Bill Ackman's first rodeo, Danny. Back in 2014, he listed Pershing Square Holdings as a closed-end fund in Europe, and his goal to raise permanent capital, giving him more firepower to invest for the longer term. A few years later, Ackman added a listing for the fund on the London Stock Exchange. But by early 2025, Pershing Square Holdings delisted from the Euronext Amsterdam and consolidated trading on the LSE. Now, here in the U.S., Ackman has tried and failed to list a closed-end fund. In 2024, he set out to raise $25 billion for Pershing Square USA on the NYSE. He then slashed the target to $2.5 billion before eventually withdrawing it entirely. At the time, Ackman cited several concerns from investors, including the more than 20% discount of his European closed-end fund to the net asset value of its holdings. So that might be a part of it. Danny?
Scarlett, thank you very much. And here we have Ackman trying again. For more details on how this new Pershing Square U.S. filing may fare and what it looks like, I'm joined by Bloomberg's Bailey Lipschultz, who has been reporting on this. Bailey, first of all, I mean, it's kind of a complicated beast. Can you describe exactly what this listing is?
The easiest way to think about it, Danny, is they're selling shares in a closed-end fund, so bringing back the entity to an extent that they tried to take public about 2 years ago. As a sweetener for that, you get a chunk of the actual Pershing Square Capital Management, the owner and operator of those hedge funds. So for every 100 shares you buy in the closed-end fund, that's what's raising between $5 and $10 billion. You get 20 shares in Pershing Square Inc., the parent company, the fund manager itself.
Clearly, it's been a Bill Ackman who's been keen to do this, be it his London listing or his attempts before. Why? Why make this move?
The whole point is to increase permanent capital. So if you can raise as much money as possible, this is going to be a fund that creates 2% fees. So if they raise $10 billion, do the math, 2% a year, helps bolster the case for Pershing Square Inc., PSI, the company that essentially is doing a direct listing. We've seen a number of companies trying to go public and wanting to access either retail investors or broaden out their investor base. Also, it doesn't hurt if you're trying to generate some paper wealth into real returns.
Certainly does not. Bailey, thank you very much. That's Bloomberg's Bailey Lipschultz. Coming up on the show, we have an exclusive interview with PJT Partners founder, chairman, and CEO Paul Taubman. Plus, later, this week's investment committee focuses on the pharma sector as Bloomberg Intelligence says that branded medicines with billions of dollars in global sales are set to lose exclusivity. That's coming up later in the show. Stay with us here on Bloomberg Deals. An already volatile market feels even more so now, entering now a wartime environment. Our next guest has firsthand knowledge of global M&A volumes and deals in the pipeline. He spent nearly 30 years at Morgan Stanley before founding his own firm, which quickly grew into an industry power player. It is Paul Taubman, the founder, chairman, and CEO of PJT Partners. He joins me now exclusively to take a look at the big picture. Paul, thank you so much for joining today.
Great to be here, Danny. Thank you.
I have to say, your crystal ball has an excellent track record. Back in October, you were talking about maybe put the pom-poms away for the 2026 deals environment. Your most latest earnings, you said that, yes, there are overly optimistic bankers, but you have a more sober view of the world. Now we add in another geopolitical risk of war. What does your current sober view of the world look like?
Well, I don't think it's a sober view so much as it's a realistic view. You have to start with what's the baseline. The baseline is we came through 2025 record levels or near record levels of M&A activity, large deals, return of private equity. But the reality is we're dealing in a world of uncertainty, a lot of volatility, and we flagged two risks. One was geopolitical risk, and the other was AI disruption risk. And in our view of the world, those risks haven't been ignored, but they've been mispriced. And it was not that long ago that we were looking at a market meltdown approximately a year ago with the whole tariff issues and the uncertainties and the like. At the beginning of this year, Greenland surfaced as an issue. So when we think about all of the geopolitical hotspots, the idea that we're going to go through an entire year unscathed, I just don't think is realistic. And then there's a longer term trend, and most industry observers have been focusing on all of the stimulative effects of AI, all of the capital investment, the jobs, the demands for power, data centers and the like. But the reality is where there's creation over here, there's disruption, destruction over here. And I don't think the market has fully appreciated that it's not necessarily a soft landing to get from all the growth and investment and world-changing capabilities of AI, but there's going to be a lot of roadkill left behind. And we're just seeing both of those in terms of the uncertainty about software, how to value it, terminal value, and we're dealing with a war where energy prices have spiked. All of a sudden, commodity costs are through the roof, and it's not exactly clear what the end game is. It'll clarify, but until it does, there's volatility, and as we all know, the biggest killer of M&A is volatility.
So maybe it's a market that's slowly coming around to where you were, and which was once a lonely view, but increasingly becoming more popular in terms of just this idea that deal making might slow down. Once the market does fully realize what you're talking about, what does that look like? What do M&A volumes end up looking like for 2026?
Well, it's hard to know exactly what they look like in 2026, but if you step back and take a long-term secular view, M&A activity should increase. It should increase because the world is speeding up. As the world speeds up, CEOs, boards of directors need to adapt. They need to respond. They need to respond more aggressively. They need to pare their portfolio, focus on core competencies. Scale matters increasingly. You need to onshore increasingly. You need to control your supply chains. So you'll see more vertical integration. You'll also see more horizontal consolidation in an effort to get to scale and to have the financial wherewithal to make the AI investments. So if you take a long-term perspective, it should be up and to the right. And we are long-term bulls on M&A and M&A activity levels. Having said that, when you come off a year that is the second best in history and you're facing these big unknowns, it's hard to think that you immediately increase by 20, 30, 50%. And that was really the only sober caution that we have. When you get to a more stable environment and there is less volatility, there's more price discovery, there's more appreciation and meeting of the minds between buyers and sellers, you'll see a meaningful return to M&A. But if we get to the $5 trillion mark, we're really in rarefied air. And I think there's a path for that to increase over time. But it's rarely in a straight line, and it's rarely just easily up and to the right. That's all we're flagging.
But considering that these are really big existential risks, AI and war itself too, are you concerned that that period, that window opening, that it gets further delayed or that it looks increasingly short?
Well, what we don't know are the tail risks. And what we don't know is there are all these unintended consequences. Once you engage in significant, hostilities and you're seeing choke points in the supply and transport of energy and all of the ripple effects that have on the consumer, on the broader ecosystem, it's hard to know where things settle out. But ultimately, things do settle at a new equilibrium, and the underlying need to transact, is stronger than ever. So it's just a matter of time getting there. And I think what you're seeing in credit, what you're seeing with software valuations, is there was a base case, there were tail risks, and the tail risks weren't properly priced in. And every now and then, some of those tail risks look a little bit more like the base case or a somewhat likely case. And inevitably, all of that is going to work its way through the system. But right now, just to take software, when there is a world where no one really knows the long-term terminal value of many of these companies, and they haven't yet been able to figure out winners and those who are vulnerable, the price discovery process is very difficult. And you see that in credit, and you see it in equity valuations, and you see it in a lack of deals. But ultimately, the market returns to a new view, you get to a new equilibrium, and then we're back to the races.
Yeah, and to be fair, corporate America has been incredibly resilient over the past few years. Just on the point of AI, because it's not even just deal making, it's financial institutions themselves grappling with this technology. How are you thinking about use of AI at PJT? How's it being implemented?
Well, the first thing is we're not looking to shrink our workforce. What we want to do is want to make our best bankers more productive, better bankers, give better advice. So we start first and foremost with how can we use this as a tool to do more with what we have, not to do the same with less. We're still a growth firm. We're looking to continue to grow. We want to expand our geographic footprint, our product capabilities. So it's giving us deep insights into how to better advise clients. We've permissioned these tools for many of our senior bankers, and we're starting with our most senior bankers because that's where we believe you can get the greatest uplift in productivity and insights is by giving that to the most senior people. But you have to be very careful about how the information is accessed, how it's permissioned. Do you have the right backbone, the right capabilities? So we've been surveying, we've been innovating, but we've been cautious about exactly how best to implement all of this. But we have the luxury of being a smaller, more nimble firm where it's more of a game of offense for us than defense.
It's such a good point. So how does that change how you think of what LLM do you partner with? Are you partnering with an LLM? Do you try to bring it more in-house? How do those concerns about privacy, data, those things factor in?
Well, that has been the debate, and that's why we've moved slowly but methodically here. And if I look at all the decisions we would have made had we been forced to pick a path 6 or 9 months ago, they would have been the wrong path, the wrong direction. So what puts everyone ill at ease is you need to move quickly enough to be able to be on your front foot. But if you move too quickly in a world that's changing at such sonic speeds, you run the risk of headed down the wrong path. So it's how do you remain nimble? How do you constantly test every decision that you've made? And I think that's good for the organization to be on edge a little bit, but to see it as an opportunity to better serve clients and to not just be accepting that there's one panacea. There's going to be an evolution and a discovery process here. And that's why you need to put it in the hands of leaders first and followers second.
Well, one of the things that this market was also very excited about deal making is this environment of regulators, of a Trump administration coming in that's more business friendly. The administration has a lot on their hands, and one of the big things that they've been concerned about is affordability. I wonder how that impacts the regulatory environment, especially for consumer companies. Is this an administration that will be the M&A world is open, even if it is consumer-facing companies?
I think it's open for many, it's not open for all. So if you just step back and look at this administration, they have been incredibly pro-growth, pro-investment, pro-strengthening the economy and corporations. And you see that across the board in terms of cutting regulation, cutting red tape. That's all good. If you look at early terminations, HSR filings, there were 6, 7 of these back in 2024. It's like 400 early terminations in the first year of the Trump administration. So that direction of travel, incredibly positive. However, in a world where affordability is a cornerstone of this administration's economic policies, you have to believe that horizontal consolidation that creates the risk of price increases on consumer goods may be a no-fly zone. So I think it's productive for deals that should be done. They're not trying to frustrate deals across the board by just elongating every deal and just raising barriers. They're raising barriers where it makes sense to raise barriers, and hopefully they'll maintain those barriers on deals that shouldn't get done. So it's a much more constructive environment, but it's not an anything goes environment.
I just got 30 seconds here, but are you seeing that in the market, that some of those companies that might have issues of affordability haven't gone fully forward with their deals? It's
certainly a consideration. I mean, every deal has to be looked at, sort of from the ground up. And instead of it being an automatic no, it's a possible yes. And then you have to ask yourself, what are you doing as far as bringing jobs back to this country, investment? What are you doing to keep consumer prices down? And if you have a holistic package that's pro-growth and makes sense, you at least have an audience. That may not have been the case before.
Oh, this has been so brilliant. Thank you so much for joining. We really appreciate your time today. That is Paul Taubman, founder, chairman, and CEO of PJT Partners. Coming up, uniform maker Cintas buying Unifirst, bringing them into the fold in a $5.5 billion acquisition. We have the details next with the reporter who's been tracking the story. This is Bloomberg Deals.
I'm Norma Melinda. Let's take a look at your midday movers. First up, crude oil is currently trading near session highs. That's despite the International Energy Agency's decision to discharge 400 million barrels from emergency reserves. Traders are weighing whether the release would blunt the impact of escalating disruptions to Middle East supplies. And in stock news, Oracle shares are surging, on track for their best day since September. That's after the company reported strong sales and forecast continued demand for AI computing. Oracle said it expects to comfortably meet and likely exceed its revenue growth forecast for fiscal 2027 and beyond. And some breaking news tied to deals. The shares of Papa John's are surging. A Qatari-backed investment fund has submitted a bid to take Papa John's private. That's according to the Wall Street Journal. We'll be following this story throughout the hour. Those are your midday movers. I'm Nora Melinda.
Nora, thank you very much. Let's talk about one of today's big deals. Cintas snapping up uniform maker Unifirst in a $5.5 billion cash and stock acquisition, aiming to become more competitive together as industry rivals bolster their offerings. Joining us for more is Bloomberg's David Cannavale, and you've been covering this story from the very beginning of it. Talk to us about the idea behind this combination. Why this deal?
So this is a strategic deal, highly synergistic. Cintas has been trying to buy Unifirst for a long time. Is the third rodeo, as they say. They've tried in 2022. They've tried again at the beginning of 2025. And they came out with a third offer in December, and it was $275 per share. And this time, third time is a charm. It worked out. They announced the deal today. Cintas is a very large company, 80 billion market cap. Unifirst is a smaller rival. 5.5 billion in value. It comes down to 155 in cash and the rest in stock. Shareholders are reacting positively to the announcement. The stock is up today. There's still a little bit of a spread on the deal right now because there could be a little bit of an antitrust risk here.
I was going to say, this feels like something that would be concerning to have these two giants of the industry come together. Is there a big antitrust risk?
There's quite a bit of overlap. If you think about the fact that the companies have expected synergies coming from the deal of 375 million, that's a lot. So we'll see how it shakes out. I mean, this administration has been quite benevolent to deals in general, even when there is antitrust risk. So it's all a matter of going through the work. I mean, the companies expect to close the deal by the end of this year, so that's a pretty optimistic expectation. The other point I would make on this deal that is quite interesting, there was an activist in Unifirst. Engine has come out today in response to the announcement backing the deal.
Right.
It was a dual class share structure, so typically activists are not successful, but in this case it worked out.
David, thank you so much for bringing us this story. And excellent reporting, tracking the whole thing from start to finish. David Cannavale. Up next, healthcare. That's the theme of RIC. That's up next. Welcome back to Bloomberg Deals. I'm Danny Berger. Let's go straight to Scarlett Fu, who's taking a closer look at how 2026 is the start of a patent cliff for pharma companies, putting them in the mood to make deals. Scar.
That's right, Danny. In the coming 5 years, Bloomberg Intelligence estimates that branded medicines with over $300 billion in global sales will lose exclusivity, creating what some people are calling a cliff. And in that context, 2026 is an early inflection point of that cliff, because just this year alone, Merck loses exclusivity on its diabetes drug Januvia in the U.S. and other key markets. Bristol Myers Squibb and Pfizer's blood thinner Eliquis starts to lose patent protection, while Bayer and J&J's blood thinner Xarelto is already seeing generic competition in some regions. And on top of that, you have Novo Nordisk beginning to lose its IP on the active ingredient in Ozempic and Wegovy in certain countries. Now, you can see the consensus revenue for estimates for some of those treatments certainly plunging. So the question is, how has the industry prepared for this pressure? Pfizer, AbbVie, and Novartis have spent billions of dollars to build out their oncology portfolio, as well as adjacent specialty areas to replace the expected loss in revenue. Danny?
Scarlett, thank you very much for that. And that brings us to this week's Investor Committee, where we take you into boardroom debates in real time. Today's Investor Committee on that. Pharma, Bloomberg's Michelle Davis joins me alongside Krishna Veeraraghavan, Global Co-Head of M&A at Paul Weiss, who's advised some of the biggest healthcare and biotech transactions, and Eric Tokat, Co-President of Investment Banking at Centerview Partners, who founded and built out the firm's healthcare practice. Thank you both So much for joining Michelle and me today. So look, we have an environment where M&A really picked up in healthcare last year, something like nearly a 50% rise in it. Eric, is 2026 the same, the more? What do you expect pharma deal activity to look like?
Thank you, Dana. I think it's going to be same or more, and it's already started that way. 25 actually was a very good year, as you suggested. We tracked the $1 billion plus transactions pretty rigorously. And we've seen a record year last year on that $1 billion plus with 26 transactions last year. And what's very fascinating about that was we also saw the breadth and the depth of the deal making was pretty wide. So we have seen early stage, mid stage, late stage commercial deals. We've seen smaller deals, larger deals. We've seen deals in different therapeutic categories, which basically is a good sign of healthy environment for deal making. And this year continued that way. So far in the year, we have seen 6 transactions greater than $1 billion. Again, and with that sort of run rate basis, it is sort of poised to be a record year as well. And the activity we see from the pharma is no less. And the core driver of that is actually, as was just presented, the pharma's need for new products and the innovation. Without innovation, no product gets sort of to be bought, if you will. And we are in that sort of early innings of this scientific revolution, which will further fuel the discoveries and new medicines, and the pharma will acquire them.
Krishna, you agree? Another record year?
I completely agree. From our perspective in this space, we're exceedingly busy right now. As you noted, Q4 was amazing for biotech, and it's continued this year. And the drivers are what Eric said, which is one is strategy. You have the large pharmaceutical companies which have these patent cliffs coming off. They're going to lose exclusivity, and they need to fill that pipeline. So there's a strategic need to do these deals. And the larger pharma companies also have an exceeding amount of financial ability and capital to do that. So they need to deploy that cash, and their investors want to see them pursue growth and fill those pipelines. And the way the ecosystem is built now, you have these smaller, innovative companies who are focused on smaller therapeutic areas, but who are going deep there. So they are perfect counterparties in transactions. You know, the pace of innovation, the therapeutic areas has never been more exciting than right now. And I'm sure you'll have questions about where we're going in areas like that. But I think the other part is sentiment is very bullish.
Well, I wanted to dig in on that because obviously it seemed like there was so much momentum coming into the beginning of the year. The fourth quarter of last year alone was, you know, we saw such a flurry of these big, over $5 billion biopharma deals. But to start the year, I know you said there have been a few over $1 billion, but it hasn't been what everyone expected. Like, what is keeping things at bay? Is it just taking longer to get things over the line, or is pharma getting spooked?
Yeah, go ahead.
I don't think it's getting spooked. I think activity, the discussions, transactional matters are as high as they've ever been. I think, you know, some of this is episodic. Deals sometimes take a little bit longer to happen than before. But in terms of the interest, the processes we're involved in, it's busier than ever. I expect this year to be better than last year.
Yeah, I agree with Krishna. I mean, I think generally it always feels like it's less than what people expect. That's the reality of it. However, it's a good activity out there. We're seeing it. We know our backlogs, and we know the level of interest. And it's across the large pharmas. It's not like 3 pharmas interested and 7 others aren't. I think across all pharmas there's interest because there's need. And I think it's going to continue that way. But as Krishna said, I mean, deal activity sometimes is episodic. You're going to see a few, you know, over a period of 4 months, and then you have seen, like, let's say in last year, there was a pause for about 3-4 months in earlier part of the year, and then between sort of mid-April to early July, we've seen 10 transactions in a matter of 7 weeks. So we see that in deal making. And generally speaking, as you said, I mean, the fourth quarter generally is the busiest because people try to wrap the year, sometimes get ready to JPMorgan Healthcare Conference and so on and so forth. So we see this sort of episodic. But I'm absolutely not seeing any pause or any concern from the pharma at this point.
So if the big pharma giants have all this firepower to buy assets, what about that pool of assets? How scarce is it, and what does that mean for things like competition and valuation?
Excellent question. So there's a lot of assets out there. And they're all competing to be the differentiator, if you will. I think in science, the trials are important, the data is important, and to differentiate sort of the molecule's properties are very important. So there is a lot of assets, but there are not exceeding amount of, the best assets, the pharma. It's also part of the deal flow. I mean, if the pharma isn't buying based on something is cheap, if you will, or something is, is within reach. It's just more like, is it sort of the data differentiated? Does it fit with their portfolio? Does it fit with their broader strategy? As long as all those boxes are checked, the deal will happen and does happen. So there is scarcity of very, very good assets, but there's enough sort of to fill in the pharma's sort of gaps, if you will, that in the coming years.
And kind of pivoting from there, I mean, there's been this narrative across M&A for the past year that kind of we're in an anything-goes environment, regulatory-wise. Do you think that applies in healthcare and biopharma as well? And could we see some of these mega MOEs, or is that just not the need yet?
We are in an environment right now where there's an emphasis on getting products in the hands of companies that can take them further, develop them, and really get to the patients. And so that's a very positive environment for transactional matters. So from that perspective, absolutely, we're seeing more transactions happen, more transactions go through. I think parties at the outset have a better certainty now that on timing and getting deals through. Go ahead.
I mean, on that, it's been years since we saw something over $20 billion. Do you think this is the year where we finally see that?
Yeah, I mean, if there is a year, it will probably be this year or next year, quite frankly, because the current environment is fairly business-friendly from the regulatory perspective. And I think people, are probably considering whether it makes sense for them to do these larger pharmas. Because, as you said, I mean, there's been very, very few very large deals. And the very large pharma, the last large pharma deals have been around 2008, 2009, quite frankly. But the regulatory environment wasn't really permissible for that either. So I think that has changed quite a bit now, and I think there is sort of a momentum towards that. Whether that happens or not, the implications of that is a very different question. But if one wants to do a big merger, our guess is that that's certainly within the cards.
Krishna, where would that come from? What is the sector that you think the biggest deals are going to be coming from? Is it obesity, oncology, something different?
I think the areas of real interest that I see the most activity are, one is the intersection of immunology and oncology. So, this is using the body cells to combat cancer. There's a significant amount of interest there, whether it's B-cell depletion or CAR T deals. I expect that to continue. That's a really exciting area, and especially for the patients. The level of innovation there is unbelievable. And then the metabolic, right? This is, the traditional GLP-1s and amylin add-ons. But also there, we're seeing people interested in alternatives to that. So those are the two areas that I think are going to have the most interest this year. And if you look back to M&A and also licensing deals as well, which are a big part of the life sciences ecosystem, both of those were the two leaders leading up to the end of the year. So those are my two areas.
I think if I agree with Krishna, but if I would answer it as deal activity follows innovation. The reason we have now more immunology transaction, broader autoimmune deals, or we have more cardiometabolic transactions is because of the innovations, right? If we had a GLP-1 available 10 years ago, I promise you people would have bought it.
Right.
But I think now with this innovation in that cardiometabolic space, I think we're seeing a lot of activity. Oncology has been the most sort of attractive sector historically in the last 20 years, 15 years, because there was a lot of innovation happening in oncology, right? I mean, a lot of the specific subtype oncology or cancer as a disease is turned into a chronic disease in some sort of categories and certain mutations of breast cancers and prostate cancer and the like. So there was a lot of deal activity there. Now in cardiometabolic and autoimmune, I would also highlight neuroscience as one up-and-coming sector for the years ahead, because I think there's a lot of shift towards addressing that as well. But broadly, the innovation will determine where the deal actually
By the way,
happen.
you're allowed to disagree with each other. I know you're good friends. I think you'll still be friends after this.
I think Eric just disagreed
There you go.
very polite way.
I was going to say a very diplomatic way to disagree. We're going to have you both back alongside Michelle. Thank you so much for joining. Thank you to today's investment committee, Krishna Veeraraghavan from Paul Weiss and Eric Tokat from Centerview Partners, and of course, our very own Michelle Davis. Coming up, an exclusive interview with Starboard Value CEO Jeff Smith, hot off the news that his firm is building an activist stake in Carmax. Stick with us for that exclusive conversation right here on Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, crude oil is currently trading near session highs. This price action comes as President Trump told reporters moments ago at the White House that oil companies should use the Strait of Hormuz. Also, Amazon is raising 14.5 billion euros or 16.8 billion US dollars in its debut euro bond sale. This marks the largest ever corporate bond deal in the euro market, surpassing AB InBev's 2016 deal. Demand for the Amazon offering was strong, with the order book topping 31.8 billion euros, or roughly 37 billion US dollars. And some breaking news tied to deals. The shares of Papa John's are surging. A Qatari-backed investment fund has submitted a bid to take Papa John's private. That's according to the Wall Street Journal. We'll be following this story throughout the hour. Those are your midday movers. I'm Nora Melinda.
Nora, thank you so much. This is Bloomberg Deals. I'm Danny Berger. Time now from premium players and a Bloomberg scoop. Starboard Value has amassed a stake of about $350 million in Carmax, seeing an opportunity to accelerate its turnaround under a new CEO. Starboard has also nominated its own CEO, Jeff Smith, to the board, and I am so pleased to say that Jeff joins us now. Jeff, thank you so much for being here.
Thanks for having me. Great to be here.
I gotta say, when you think about classic activism, you think about someone coming in, trying to change management, a new CEO. This feels a little bit more friendly, for lack of terms. Why Carmax? What is the strategy?
Yeah, well, a couple things there. So, activism is about finding good businesses where we think they can perform better. And when we get involved in companies, there is the part that everybody focuses on, which is the early stage, where you may be on the same page as the company or a different page, and you're pushing them to do more, and you're pushing them to do it faster. But then you get to the middle stage where you're working with the company either on the outside or very frequently will be on the board and working with the company on the inside. And it becomes extremely friendly and collaborative, where we're working together to try and create value. So in the Carmax situation so far, and I hope it stays that way, it has been collaborative and friendly, and we are enjoying the conversations we've had with them. There's a big opportunity, which we should talk about.
But please, what is that opportunity?
Well, Carmax is similar to a lot of businesses that we target, that we look for, which is a business that is a leader in its space, usually carved out a niche for itself, and then sometimes as it becomes more mature, it becomes a little more complacent, and somebody else might come along and start eating at it. And I think as I'm describing that to you, you can understand that Carmax fits that. So Carmax kind of revolutionized used car sales and made it something that was a much better experience for consumers. And they still are the leader in used car sales, but then there's been some others that have been catching up, notably Carvana, especially with the digital experience. But from our standpoint, we actually think that Carmax is better positioned. So they have the benefit of the omni-channel footprint. They have over 250 locations, physical locations, where you can go and test drive cars and touch and feel and see those cars. And they have the digital front end. So we think they have the best of both worlds, and you're effectively getting that asset base that's almost impossible to replicate for free, because we're buying into Carmax at tangible book value. I don't know that you would build this business today with all of those assets, but we don't really have to pay for it as shareholders. They're there, you're paying tangible book value for a business with all of these assets. And now if you can make it sing, you have the best of both worlds. So they're working on that. They need to fix the digital experience for the consumer, which we can talk about.
Yeah, how do you fix that? How do you fix a digital experience, especially when you have this big looming disruption of AI overhanging everything?
Yeah, well, actually, we put Carmax into the bucket where it shouldn't really be affected much by AI. And it's interesting you bring up AI, and we can talk about that too. But we kind of put it into three buckets. So there are companies that people think are going to be disrupted by AI, and then a bucket where companies shouldn't really be impacted too much by AI, and then other companies that are considered AI winners. we kind of put Carmax in the middle bucket where it shouldn't really be directly impacted by AI. There may be indirect positives and negatives. Actually, there's a big positive. But for the most part, people are looking to buy used cars and have a used car experience. As it relates to fixing the omni-channel experience, it's really just putting them side by side next to each other as a user. So pretend like you're going to buy a used car, maybe you are going to buy a used car, or sell your car and go online, whether it's Carvana, Carmax, or any others, and put them up next to each other. What we found is the experience with Carmax is just clunkier. There's too many steps. There's too many choices. There's too many opportunities to drop. It's too complicated. But that's the good news, right? That sounds bad, but from an activist standpoint, that's the good news, because you look at this business and you say, that's easily fixable. Right. We have all the assets. We have consumers looking to transact with us. We can fix this without having to change the business all too much. It's actually fairly easy to fix. It takes some prioritization, but it's fairly easy to fix. And you get to buy into this business at a single-digit multiple and at tangible book value. And then we get very, very excited.
By the way, looking at your recent campaigns that you've announced, talking about does it fall in the AI disruption bucket, does it not? You have on one side Lamb Weston that makes French fries, so I can't think of anything less likely to be disrupted by AI. And then on the other side of things, you have TripAdvisor, where the market has been freaking out that things like TripAdvisor will be completely replaced by AI. I'm guessing it's not a coincidence that you have these two companies that seemingly sit on the opposite ends of the spectrum.
Yeah, look, Lamb Weston, one of the leaders in producing French fries, it's really a fairly small number of producers that can make French fries, and they are set up to succeed and had some issues, and they're fixing those. We've been watching Lamb Weston for a long time. They're already improving, and we get to buy into Lamb Weston at a lower price than we've been looking at it for the last year and a half. So we're very excited to be able to own it here as they're on their journey. They've announced that they can reduce their overhead by about $250 million. We think they should be able to do twice as much, and we think they should look at their international operations and rationalize those. But we get to buy into that business at a mid-single-digit multiple, and that's pretty exciting, but should not really have as you mentioned, should not really have a direct AI impact. On the other hand, as you're mentioning TripAdvisor, love TripAdvisor. TripAdvisor is really three businesses. It's core TripAdvisor, and then it's TheFork and Viator. People look at TripAdvisor and really think about TripAdvisor.com, the legacy review business that still exists and produces a lot of cash flow, and think of it as a company that might get impacted by AI. But because of that, we get to own this whole thing at like 3 or 4 times EBITDA. If you can own something at 3 or 4 times EBITDA and you can improve the cash flow and the good assets, they're all good assets, the growing assets of Viator and TheFork, which are actually marketplace businesses, are worth way more than 3 or 4 times. You can create legacy Trip for free, or however you want to look at the sum of the parts, it is worth way more than 3 or 4 times EBITDA. So we've been talking to them about how they have to think through their business, how they have to transform the core Trip business and use AI to be an AI winner as opposed to be a potential AI disrupted company, and then continue to accelerate the growth on TheFork and Viator, which are great marketplace, double-digit growing businesses.
It's a great example about how AI is both an opportunity and a threat. Has today's chief executive fully grappled with and have the tools to realize the opportunity side and not just the threat side?
It depends on the industry, but I would say not yet. I think if you talk about the software industry, you have management teams, CEOs and management teams that are more at the leading edge of utilizing AI in their business and trying to get ahead of things. If you move past that and move into industries that are less tech forward, I would say CEOs are trying to figure out how best to utilize AI for their benefit. The interesting thing across all sectors is that AI is going to be a benefit first for just about every company. AI is going to allow companies to reduce costs, improve margins to the extent they want to. AI is also going to be able to improve the user experience, the customer experience, if it's used well. So the beginning stages of AI, regardless of industry, should be very, very positive. The challenge that the market has in trying to assess many companies, which is why multiples have compressed, is trying to figure out when, if ever, companies might get disrupted by AI. And it depends on the industry, it depends on the company. But we have conversations with CEOs all the time in different industries. I just did the other day, or actually yesterday, and talked about it. And they're just at the beginning of utilizing AI, understanding that they need to take a look, in particular, at their G&A, and they need to make sure they're as efficient as they possibly can, utilizing the tools that they have. It's not the first time companies have used technology to help them be more efficient.
It's the first time, though, that they have this beast and this new technology. Jeff, I only got a minute here, but is there a deep enough talent pool and resource bench for these companies to turn to navigate this environment?
Not yet. Not yet, no. So depending on which company you're working with, I would say that boards are working with CEOs. They're asking questions. They're saying to the CEO, what are we doing with AI? It's a very broad question. It's not a detailed one. And I would say that many companies aren't fully able to utilize this yet. They're just now thinking about it. They don't, to your point, Danny, they don't have a place to go. Or they don't have many places to go to bring in help to consult and say, hey, this is the answer. This is what you do. This is where you go. This is how you implement AI to improve your user experience or to improve your margins and reduce costs. It's something they're figuring out as they go.
All right, Jeff, we could spend literally all day talking about this, so you're going to have to come back again and join us. Thank you so much for your time today. That is the Starboard CEO, Jeff Smith. And that about does it for today's episode of Bloomberg Deals. To stay up to speed even after the show, subscribe to the Bloomberg Deals newsletter. Up next, Balance of Power live for Washington, D.C. We will see you back here next week, same time, same place. This has been Bloomberg Deals.